Okay, I guess we can start now. Great, so let me share screen. Oh, share some. Great. Welcome everyone to this webinar titled Things to Know Before Investing in Cryptocurrency. I am one of the presenters. I am Lily Anna Resort, founder and CEO of SupraFin. I have 20 years experience in fintech, investment, risk analytics, trading, investment banking, etc. From tier 1 financial institutions as shown in this presentation. I'm going to pass it to Laurent so that he can introduce himself. Laurent?
Hi, thank you. Hi, everybody. Welcome. My name is Laurent Guyenne. I'm then Chief Quantitative Officer in SupraFin. And before that, I was head of quants in IHS Markit in the US. And I have over 12 years experience building all kinds of models, especially for risk and hedging in a number of also, I think, well-regarded places.
Great. So we're going to proceed with the presentation, and then at the end, we will do a Q&A session. So what are some of the things you need to consider when investing in cryptocurrencies? First, you need to know what are cryptocurrencies, also known as crypto assets. In simple words, a cryptocurrency is a new form of digital asset that is based on a network, and that network is known as the blockchain, which is distributed across many computers. Because this network, the blockchain, has a decentralized structure, it allows cryptocurrencies to exist outside the control of any central authority. And it really offers an alternative payment network to that of the banking system. People use cryptocurrencies for many things, for purchases online, for investments, for peer-to-peer payments, to get certain discounts on certain companies, to get exclusive access to certain platforms, etc. There are many cryptocurrencies. There are currently more than 3,000 cryptocurrencies traded over 300 exchanges. And actually, I see a question right now, but as mentioned, we plan to do the Q&A at the end. Then also, cryptocurrencies are quite complex to evaluate as investments. And this is because there are different types of cryptocurrencies, each of them with their different levels of complexity. For example, exchange tokens. These are cryptocurrencies that are not issued or backed by any central authority, and that are used with the means of exchange and as economic incentive to maintain a particular public blockchain. So a particular exchange token, like let's say Bitcoin, is linked to the Bitcoin blockchain. And Ethereum, which is another exchange token, is linked to the Ethereum blockchain, etc. There are hundreds of these exchange tokens. And the business model for exchange token is something that is not related to the way you evaluate equities or fixed income or other securities that we are familiar with. Utility tokens are cryptocurrencies that grant access and discounts to a current or prospective product or service. Each utility token has their own type of structure, and that makes them unique and also adds some level of complexity when it comes to evaluating them. Utility tokens are not linked to the profitability of a company, and so hence it's also a very different business model than what we are used to evaluating. Stable tokens, those are cryptocurrencies that have relatively low volatility. For example, cryptocurrencies that are collateralized by fiat, like the US dollar, obviously the US dollar has relatively low volatility versus many things, including cryptocurrencies, equity, and so on. Security tokens. Currently, there are mainly exchange tokens, utility tokens, and stable tokens that trade. Security tokens is a new type of cryptocurrencies. I would say maybe a more futuristic type of cryptocurrency where these tokens are linked or collateralized by shares or debt instruments or other securities. And the complexity of a security token is going to depend on the complexity of the structure of that security token. Again, we don't have many of these, so that's to come in the future. So now I'm going to pass it to Loan to discuss the fourth point as to what are the things you need to consider when investing in cryptocurrencies.
Yes, thank you. So as Lilia mentioned, there's several kinds of cryptocurrencies, more than 3,000 of them in existence currently. And one of their characteristics is that they are very volatile, these cryptocurrencies. So here on this chart, we plotted the volatility of some cryptocurrencies versus the volatility of some equities, so the NASDAQ and S&P indices over the past 12 months. And we can see that, so at the bottom, you can see the little crosses, which are the volatility of the equity indices. And all these colored dots are the volatility of the cryptocurrencies. So the first observation we can make here is that equity volatility, if you thought equity is volatile, we can't see the charts, somebody is saying.
Oh, which chart?
Okay, some people, Catherine can see it, Rohan cannot see it. I don't know what.
Well, I guess it's unique to your. Yeah, okay. You can see
Most
it. Okay,
can see that. Thank you.
Okay.
Sorry, Rohan. Then
fake news.
I hope it gets fixed for you. So yes, the first observation is that the volatility of cryptocurrencies is always much higher than the volatility of equities in all sorts of situations. In particular, so you can see the big spike on the left around March 2020, which corresponds to the first lockdowns related to COVID-19. So sure, the volatility of equity spiked a lot to almost 100%. The volatility of cryptos spiked even more, as we can see. Then in the summer of 2020, the situation got a little bit more normal for equities, not quite normal, but a little bit more, not like in March. But for cryptos, it's still all over the place. Some have lower volatility, some still have very high volatility. Now, we can observe again increased volatility related to the latest rally with the cryptos. So this generated also increased volatility, while in the past couple of months, while for equities, we didn't see that. And so Pat asked a question about Ripple, then you can see that, I don't know what the decision will be, but the volatility of Ripple certainly increased a lot lately.
Yeah, and I guess just to add there, I guess it's so interesting that typically volatility of equities, like S&P, for example, tends to be around 20%, and the NASDAQ, sorry, that's the NASDAQ. S&P is more around 12% and so. And well, the ones for cryptos are just like twice, 3 times, 4 times, sometimes that of equities. Okay, so sorry for the interruption, Lond.
No worries. No, yes, exactly. So this shows us the main one of the things. I think the first thing we should know before investing in cryptocurrencies is that they are very volatile, and even more volatile than equities. If you invest in equities, you should think that cryptos are more volatile than that. So the question with cryptocurrencies being very volatile is, can you stomach this volatility in your investment? So volatility means in the latest rally, we saw the price increased a lot, especially the price of Bitcoin, but it means also the price can go down very much. And with the very high level of volatilities, it means the price can go down very fast. So for example, between January 8 and January 12 of this year, the price of Bitcoin went down 17% in 4 days. So you have to ask yourself, what do I think about that? What would you do? Can you stomach it? Are you fine with this kind of behavior or not?
Great. So now, how can then you lower the volatility of your cryptocurrency investment and improve potential returns? Well, so instead of investing in one cryptocurrency, you might want to think of the benefit of diversification by creating a portfolio of many cryptocurrencies. Then the other thing that you might want to consider is carefully selecting these cryptocurrencies. Obviously, the goal should be to try to select the best cryptocurrencies. And by that, I mean best versus your investment horizon. So if your investment horizon is medium long term, then you need to have the best cryptocurrency for that horizon and not just the ones with investment potential investment horizon of being the best in the very, very short term. Because a cryptocurrency that in the short term could be good could end up being a very bad investment in the medium or long term. And so this matters a lot. And then last but not least, we all have different risk preferences. Some of us have low risk preferences, medium risk, high risk. And so once you understand your risk preferences, then you should create a portfolio that caters to your risk. So there are ways of creating a portfolio of cryptocurrencies where the risk of the entire portfolio is lower than that of another portfolio that has other cryptocurrencies with more risk or volatility. And so these are things that usually, on average, people use during any kinds of investment processes, but this also needs to be used in cryptocurrencies. And so how do smart investors invest today? Well, they try to develop a deep understanding of the asset class where they are going to invest, in this case, cryptocurrencies, and then they develop the investment strategy and framework. So they use their critical thinking for that. And then they use a data-driven investment approach. What does that mean? That means you need to get the right data sources and automate the investment process. And how do you automate the process? You leverage technology. And while you cannot invest all of the investment process, you can automate many, many components. So for example, tracking developments on the crypto market, a lot of that can be automated. Crypto selection, part of the process of selecting the best cryptocurrencies can be automated. Portfolio diversification, monitoring each cryptocurrency or the portfolio, that also can be automating, and the rebalancing of the portfolio, etc. Because while humans are excellent for critical thinking, they will never be as good as a computer when it comes to computation. And so the other thing you want to consider is how have cryptocurrencies performed in the last 12 months versus other asset classes. So in the last 12 months, we saw a performance of cryptocurrencies, some which did extremely well and some others that did relatively bad. There are 3,000 cryptocurrencies. I've only plotted some few here just for illustration purposes. For example, you see that in the last 12 months, Ethereum had a 712% return. That's obviously a huge cumulative, these are cumulative returns. Bitcoin had around 300 and with their 80% return. That's again huge as well. No, 320, sorry. And then you have, how does this compare to equities? You know, the most, typically in equities, one of the indexes that trades with the most volatile and with the most potential is the NASDAQ. So I plotted the NASDAQ. So NASDAQ experienced 40% cumulative returns for the last 12 months. So because cryptocurrencies are a new asset class, so some cryptocurrencies are going to do extremely well. But again, you're going to also have a lot of cryptocurrencies that are just going to do extremely bad. And especially now, as you have now more smart investors getting into the market. Many years ago, some of these cryptocurrencies traded, you know, in similar ways. But now the performance of cryptocurrencies in terms of being observed in the market has started to change dramatically, as well as the volatilities. And so, given all we told you, for us, so SupraFin is my company, and we've tried to help. What we want to do is help any individual invest like a professional by automating the process, the investment process. And this is why SupraFin is a smart platform that helps anyone invest like a pro. I'm going to show you a small video of SupraFin. Let me know if you don't hear the video, but I think it should work. It's a small video that will tell you what SupraFin does. So you want to buy and sell cryptocurrencies online? Easy. SupraFin allows you to invest in cryptocurrencies based on the risks. With our smart automated app and online platform, you have complete freedom and knowledge to invest what you want anytime. I am Liliana, the founder of SupraFin. I have 20 years experience in cryptocurrencies, fintech, and investments from JP Morgan, Morgan Stanley, and Deutsche Bank, among others. There are platforms that allow you to buy cryptocurrencies, but in my knowledge, they don't evaluate and recommend which ones. We are here to give you the time and expertise to select the best cryptocurrencies to create a diversified portfolio. Here's how it works. The platform first evaluates a client's preferences for risk. Then it recommends a portfolio of cryptocurrency from our extensively evaluated database. You can invest whatever you want directly through the SupraFin platform, which monitors the portfolio with buy and sell recommendations. Simple.
In my view, everything available in the market is designed for traders. They know exactly which and what cryptocurrencies they want to buy, but the majority of people don't. With the rising number of people wanting to buy cryptocurrencies, we are seeing a frustration with the lack of knowledge, tools, and the time to evaluate hundreds of cryptocurrencies and select the best. That's why SupraFin is unique. It answers a huge problem in this sector and is a vital next step that has been overlooked until now. In addition, it brings financial inclusion, as anyone can buy or sell cryptocurrencies through the SupraFin platform.
So the SupraFin platform brings many benefits to investors or customers. It brings simplicity, very simple to use through an app. It has investment risk models that helps you invest like a pro. It does the entire automation of the investment process. It brings transparency. People can, once they invest in their cryptocurrency portfolio, they can see exactly what cryptocurrencies are in their portfolio. It leverages public blockchain, so we don't use synthetic products. Automation, we automate most processes. And customized because it creates diversified portfolio of cryptocurrencies based on the risk profile or preferences by the client. We talk about investment risk models that help the platform select the best cryptocurrencies and create these portfolios. I'm going to pass it now to Laurent, which can tell you more about the performance of the portfolios that were selected by the SupraFin platform.
Yes, thank you. So as Liana mentioned, how did we do it? So we have proprietary risk models to evaluate different cryptos. And so we created 3 portfolios with 3 different risk levels. We have the blue one at the bottom, which is the low risk, the medium risk portfolio, and the high risk portfolio. And here we see the performance, the cumulative return of these portfolios over the last 12 months versus the Bitcoin, which is the crypto of reference that everybody knows. So we see that the low and medium risk, which have lower risk than Bitcoin, perform okay. So they don't have such a high return as Bitcoin, but then in risk-adjusted terms, they do perform pretty well. The high-risk portfolio which has a higher risk, then outperforms Bitcoin by a large margin. So the next thing is we showed you in the last slides what happened in the past 12 months. Here we zoom in and what happened in the lockdowns, this lockdown period, which was everything had experienced a lot of losses or declines, we should say instead. So let's look at what our portfolios did during this lockdown period. So Bitcoin had a cumulative return of minus 26%. So these are since January 2020. Our portfolios, which benefit from risk analysis and the diversification, had also declines, but not as much as Bitcoin. In particular, our lower risk portfolio came to a cumulative return of 1%, which is not even negative.
So if you are interested in the SupraFin platform, using it as a customer, sign up for early access and to download the SupraFin app.